Okay, folks, welcome to Thursday Night Stock Charts Live. This is Bob Desmond and another Thursday. All right, a big week as expected. Big day yesterday, big day today. But the after-hours session is a little bit mixed, given that we have some volatility. FedEx came out after hours and reported their earnings, and it was no bueno. I'll put it to you this way. The anticipated market maker move on their earnings report was about 2150. Let's call it 2150. The move after hours, they closed at $339. Last tick, 268.46. So anybody that was selling close to the money, put options, just got wiped out. So not good. We'll check out the NASDAQ futures, the E-mini futures in a moment. The transports had an outstanding day. They had an outstanding week this week. Let's see how they hold up tomorrow in light of this. So let's talk a little bit about their report. And Barron's has a blurb here. And one thing stood out at me that mattered quite a bit, and it had to do with growth. Let's first take a look at the top line here. FedEx reported adjusted earnings per share of $3.60 from sales of 21.6. Wall Street was looking for earnings per share of $4.75. Wow, that's a big miss on EPS. And $21.9 billion. All right, not a big miss on revenues, but the EPS really took a hit. The year ago period, they earned $4.55. So their earnings are contracting. They're making money, but they're contracting. A year ago, the company earned $4.55 on sales of $21.7 billion. They tacked on another $100 million over last year. That's not good. That's not providing value to your customers. And I'm not saying it's their fault. In all probability, it has to do with the economy. Now, looking ahead, and this is what jumped out at me earlier. Looking ahead, FedEx expects to earn between $20 and 21 cents a share for fiscal 2025. The range given in June was for 20 to 22. That's contraction. So something's happening there in their business, in the economy, and everything else we know here for the most part. It wasn't a strong report. The lower demand for premium services contributed to the disappointment. Industrial customers are relatively heavy users of premium services. Think of shipping of value, high-value microchip, a medical device. The weak industry activity has been started to show up in FedEx results. The weak industry activity has started to show up in FedEx results. Weakening industrial activity is one of the reasons the Fed cut interest rates by an aggressive half basis point cut on Wednesday. My guess is that the Fed had these numbers well in advance of yesterday. They knew what was coming out, because we're going to go to statistics in a moment that were released this morning that just don't support a Fed rate cut. I'm going to go to the Federal Reserve of Atlanta's expectations for GDP growth for Q3. It does not support a rate cut. So let's check in with the rest of the market. How is it responding to the FedEx report? Not horrible. The E-minis are down 0.4%. Not bad when you consider it was a big up day. So a push. NQ, you wouldn't imagine much of an impact here. They're down 0.08%. Checking in with yields, 10-year yield is down half percentage point. The dollar is up fractionally, 0.12%. VIX is asleep at the wheel, as it was all day long. So that's the most recent news after hours. Talon, thank you, my friend. Appreciate that. Dane. Hey, Bob, crazy week. I always thought a big rate cut usually means the economy is weak and typically drives the market down or lower. We're going to go over that in a minute. Remember that we have knee-jerk reactions, right? So we don't have, between now and the next payroll numbers, we don't have a lot of economic data. We're going to get CPI, I think, the week after next, along with some jobs data, non-farm payrolls perhaps. And I think right now we could be in cruising altitude for the market until those reports come out, either confirming the fears of the Federal Reserve on jobs or leaving us going, what are you talking about? What's your concern with jobs? And or CPI. And I don't think CPI is going to be as big of an issue as one would think for September, meaning the number that we get out next for CPI, the Consumer Price Index, is going to be for September. Remember, for the most part on the month, commodity prices have been weak. Is insurance high? Yes. Is tuition high? Yes. Is healthcare high? Yes. Is housing high? Yes. But we don't have the influence of agriculture or energy pushing up that number for September dramatically as of yet. I think for the October read, for the November read for October, that's going to change. So let's get to it. Mr. Sean, welcome. Okay. Let's we're doing over FedEx. We could skip this. I want to talk about the obvious here, because we're at the point now where we know what history tells us about the market when the Federal Reserve starts cutting interest rates. We're going to go to more data of what has happened in the past when the first rate cut is a half basis point cut. So I want to talk about this as well. So let's talk about today's economic data. Let's talk about the week's economic data. Let's put things into context. I don't want to cherry pick here. So Empire State Manufacturing Survey, the median forecast was for a negative read, meaning contraction. Actual expansion by a mile. U.S. retail sales, median forecast, a negative expectation. Actual, a beat. X autos, a miss. Industrial production, a beat. Capacity utilization, a beat. We're producing more without using expanding. We're maximizing our industrial capacity. We're efficient. We're producing more with what we have now. Business inventories rose a little bit. That's, if anything, deflationary, because that means that businesses, retailers may have to cut prices to get rid of the old stuff so they can make room for the new stuff. Home builder confidence, beat. Housing starts, beat. Building permits. This is a forward-looking indicator. Building permits, beat. We know what happened here. Fast forward to today. Initial jobless claims, a beat. 10,000 less than what was expected. That's good news. What was it? The previous read was 231,000. Philly Fed survey, they expected a negative read here. Actual came in a positive 1.7. That's a mind-blowing beat. Existing home sales, minor miss, not a big deal. U.S. leading economic indicators, less worse. They expected contraction. They got contraction, but not as bad as expected. Looking out into next week, we're going to get PMI. That's the Purchasing Managers Index. We don't get jobs next week. We get a revision to GDP. The PCE, we get some inflation numbers. I don't think this is a big deal next week at all. So it's the week thereafter that we need to concern ourselves with CPI, with jobless claims, and not even so much the CPI report. Now, going back to today's economic data, all this, for the most part, by and large, not bad. Not bad at all. So initially, I went to the FedWatch tool, and what I was watching very, very closely was this number here. The expectation for a quarter basis point cut in their next meeting, which is November the 7th. This jacked up to over 70%. Then it dropped down into the 50s. Now it's balanced out here a little bit. We're at about 61% probability of a quarter basis point cut. So we went almost 50-50 with the probability of a half basis point cut. You know, when I see volatility like that, I have to ask myself the question, what are they worried about? What's going on that they're worried about? Are they playing politics? Every Fed chair has done this for preceding presidents. This is not a Democrat, Republican thing. This is a Fed chair who's just trying to protect his legacy, protect the independence of the Federal Reserve. So even though Powell's a Republican, he's going to help out a Democrat to protect the institution. They are going to circle the wagons to protect the institution. And if they can get a bull market rally going into Election Day, so be it. However, they're playing with fire. And here's how they're playing with fire. Take a look at the Shiller PE ratio. We're nearly 37. We are at the highest level since right before the COVID sell-off in 2020. Buffett indicator. We remain strongly overvalued. We are piercing through this 2 standard deviation move on the Buffett indicator. The last time we were here, you guessed it, right before the COVID crash, 2020. When were we there before that? 2000. What was that? Dot-com bubble. And before that, in the 1970s, I was too young to remember exactly what happened here, to be honest with you, but it didn't end well. So I do know in 1971 they took us off the gold standard, but that is not 1971. Federal Reserve's balance sheet for last week. They said that they were going to continue to roll off debt off their balance sheet. This is no great surprise. Now, let's do a little bit of history here. The last 2 times the Fed's first cut was 50 basis points. January 3rd, 2001. Employment, S&P 500 fell 39% over the next 448 days. Unemployment rose another 2.1% recession. Next time, September 18th, 2007, prelude to the financial crisis. S&P 500 fell 54% the next 372 days. Unemployment rose another 5.3%. Recession. What are we now? And we're going to go over the charts, the weekly charts in a moment, to try to identify areas of the economy, such as regional banks. I haven't taken a look at them today to see how they're performing. They could certainly be a problem for the rest of the economy. I mean, just take a look at this post here. Minneapolis, office building totaling 1,000 square foot in downtown Minneapolis. Look at how pretty this building is. Just sold for $6 million, or a shocking $10 per square foot. That represents a 91% discount to what the seller bought the towers for $74 million in 2019. Do you know how many buildings I've shown on these live streams in the past and how many I haven't? It's got to be over 100 already. The meltdown in Class B, C office properties across the U.S. is beyond wild. So stay tuned for more updates just like this. This is Triple Net Investor. If you're looking for them on the Twitter sphere, I will copy you in here. So is it a regional bank issue that they're worried about? I don't know. I don't know. Because something's out there that's bothering them. Because when you take a look at the GDP Now report published by the Federal Reserve of Atlanta, I went over this with members the other night, and I figured I'd share it here. They're putting out a report for Q3 2024 that's expecting GDP of about 2.8%. Riddle me this. If you have an economy that historically has grown over the past 50-odd years at 2%, and we're printing at current at 2.8% quarterly, and when I say 2%, that's annual terms, a 2.8 quarterly GDP, what do we need a rate cut for? Are we going negative in Q4? And to be fair to the blue chip consensus, these are market participants, they're expecting in reality far less than that. And it kind of makes sense because Atlanta Federal Reserve has a habit of overestimating and then under-delivering. So no great shock there. But right now, this is the data that we have. And the Federal Reserve, I can't emphasize this enough, it's only happened twice in the past 20 years where the Federal Reserve, actually 25 years, 25 years where the Federal Reserve has initiated a new rate cut regime with a 50 basis point rate cut. So it's either politics or there's something out there that they have access to. Remember, the Federal Reserve, if you're a bank, you have to have an account with the Federal Reserve because that's where you park your reserves. So they have access to see what your liabilities are, and they also have a window. Unlike Chase competing against Citigroup, they can't see exactly what's on their books at any given time. That's why you have a bank of last resort like the Federal Reserve. They don't trust each other when things get hairy. So what do? They park their cash with the Federal Reserve. So the Federal Reserve always has a window into what these banks have at any given time. So that way they know who they need to let go under, or have bought out. If you ever wonder how they do that over a weekend, they know well in advance. They have more information on the bank than the bank is willing to fess up to because they're objective. They'll take down that bank along with the FDIC and the SEC if they're public. So them cutting by a half basis point is huge, huge. And it's not unexpected. We knew it was going to happen. Why? The Fed Watch tool told us. Everybody on CNBC, when they announced it, was, oh my God, can't believe this. It was expected. Don't get lured into their feigning of shock and how bullish this is for the market. While yes, in the short run, it's probably bullish for the market. I've fessed it up. I've said it. Yes, it probably is. Longer term, we better have earnings that come out gangbusters. Because if they miss, this is going to get real fast. Because if they miss, or if they even come in on par with what's expected, it ain't going to be enough to keep this market up. This is posted by Financial. Half basis point cut is panic. Powell is intentionally causing an inflationary bear market to delay a crash and make a recession far worse. I'll explain what he means by that in a moment. Combined with Yellen holding the yield curve inverted for the longest period in history, we aren't getting out of this. I think he's got a typo here. Oh, I'm sorry. No, that's wrong. I misread it. Getting out of this without mass unemployment and poverty. So basically, this is just the yield curve. We'll go to that in a moment. And here he's got unemployment rising. We've known this. Average overtime hours of production is, while it's hiking, it's moving up higher at current. The trend is clear, it's defined, it's down. Cutting rates is a mistake unless they intend to postpone the crash by creating an inflationary bear market. Basically, the markets would decline but not crash because commodity speculation prevents it. But he's missing something here. This should also potentially stave off unemployment from rising. That's the last thing they want, is a bad jobs report coming out right before election day. So let's talk about his logic. Is it sound? Let's validate it, right? He's got a hypothesis. Let's validate the hypothesis, although it's very soon. Let's see where he's at this snapshot in time. So the CRB commodities index, just a basket of commodities. What are they doing? Are they going up? Are they going sideways? Are they going down? They're up over 2% on the week. Geez. Okay. Look at this. It's not just that they're up. They're about to break out, potentially. This is a weekly chart, not a daily chart, but a weekly chart. What else is going up? Crude prices alone this week up over 3.5%. We're going to go to the distillates in a moment. Let's take a moment, take a look at natural gas. Natural gas is up on the week. The however is this is setting up for a major, major bull run. How do I know? Glad you asked. What you're looking at here on natural gas is a Bollinger Band squeeze. Bollinger Bands in black, Keltner channels. They may be a little bit difficult to see on your side. Well, you can see them on your side in gray. Once you get these Bollinger Bands trading within the Keltner channels, that sets up for a Bollinger Band squeeze. The last time you saw that was right here. Boom. Here. Boom. Here. Not so much here. It didn't happen here. But these past two times, it happened. Let's take a look at what it looks like on a weekly chart. I'm sorry, UNG. I'm looking at the dollar. Yeah, this looks more closer. Still the same thing. Bollinger Band squeeze, very, very tight. I knew natural gas was up today, so it didn't make sense. Big move up higher today. I think that this is breaking out higher, a lot higher. Let's go to a weekly chart of natural gas. A little bit of resistance up at $15 on UNG. I think we're breaking out, folks. So what does this mean for the rest of the market? So this is where everything becomes a bit of a speculation, right? This is the JOLTS numbers. You know, the Federal Reserve is looking at non-farm payrolls. He's looking at unemployment numbers. What he should be looking at is job openings. The job openings do not lag. Job openings are a forward-looking indicator. Unemployment is a forward-looking. There's a lag there. When we go into recession, The last thing that people want to do is lay off their people. They want to keep that's their business. So the last thing they want to do is let them go. They'll cut overtime, and we're seeing that already. You saw that here. Overtime in a decline. We've got that, but unemployment is picking up. Job openings are lagging at best. So what does this mean for the equity markets? I don't think this is updated for today. This is the 18th. Today is the 19th. This is not updated yet. So this is probably less worse today than it was yesterday. This is a weekly chart of the put call ratio. Now, I titled this live stream market sentiment. I included that in there because what we're doing now is we're taking a pulse of the markets and we're saying, okay, here's the knee-jerk reactions to the upside. Right? Yesterday, when we had the announcement by the Federal Reserve, the knee-jerk reaction was up, then it was down. But you also get a lag effect a couple of days out. You want to let the market settle down, absorb what's going on, take a look at the volume if it's an up day, take a look at the volume if it's a down day. Did you see institutional selling or are you seeing institutional buying? We don't know yet. We'll go to those charts in a moment. But if it's not institutional buying or selling, you need to look at that price action with a lot of speculation because institutions are going to drive the markets where they're supposed to be or where they want them to go, not retail investors. They're usually late to the party. So put call ratio is coming off of a pretty oversold level. And over here in black, I have the S&P 500. And you can see that once you get a oversold reading, you tend to get a correction in the equity markets. Now, why am I still in the camp of we're going to get a correction? Folks, all you need to do is take a look at the yield curve. We talked about this for at least 2 years now. And the yield curve is so uninverted, it kind of makes me nauseous now. And when you take a look at this on a monthly chart, and you look where we're at, this gray area here is a range that I drew many, many months ago to remind us of as to what range generally does the equity market tend to buckle under the pressure of the yield curve steepening. And what rises with the yield curve? Unemployment. They tend to correlate. And that's why usually you see a recession after the yield curve uninverts. And you're seeing that. Where is it? Here. Unemployment rising. Yield curve rising. So we are at the precipice of entering this gray zone here, where in gray we have the S&P 500, yield curve uninverted. We were at about 0.23, and we rolled over. Where are we now? 0.14. Then fast forward to the financial crisis. We made it all the way up to 0.64, and then we rolled over on the yield curve. So we can still see the equity markets press up higher here, but you need to be aware the analogy I'll draw is this, is that you ever see when you were a kid, you were watching cartoons and you had a bad guy that was standing on the railroad tracks and he's looking down a black tunnel and he sees his little light at the end of the tunnel. He decides he's not going to get off the railroad tracks, and that light keeps getting bigger, 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 and all of a sudden that train is right in his face. So this is my correlation, or this is my analogy for the yield curve uninverting the way it is. We have history on our side. Since 1955, this has predicted every single recession with the exception of, I think, 1965 it went uninverted, reinverted. There was no recession back then, but it was only like a blip on the screen. All right. More inflation data. Conveniently, this is no longer, coffee is no longer included in the CPI data as of about 2 months ago. So the CPI number that you're getting right now is not the same as it was 2 months ago. It's not the same as it was in the 1970s or 1980s. It's not the same as it was 2 years ago. It's much, much higher. Also, the unemployment rate. This here is the U3 number out of the Bureau of Labor and Statistics. The U3 number puts us at about 4.2% unemployment. This is a new number on a relative basis. What do I mean by that? You didn't have a U3 number back in the 1990s. They just brought it out in the 1990s. Oh, look at this. This is our brand new unemployment report. It looks a lot better for the politicians in the Federal Reserve. The number that they used back then, but don't talk about anymore, is the U6 number. Unemployment at current is over 6% and rising. Both the U3 number and U6 numbers are rising. What does that correlate to? A rising of the yield curve. Rinse, wash, repeat. Every single recession over and over again. I don't make it up. That's just the way it was when I got here. Let's go to the weekly charts. So what I'm going to be looking at now is a couple of things. We want to continue on with sentiment. TZ Burton, welcome. We want to begin with sentiment. And I can only understate how big of a problem this is right now. So you had the markets move up today because the Federal Reserve cut rates. You don't want to fight the Fed. History has shown that 6 months down the road, a year down the road, 3 years down the road, equities will be up. So why am I talking bearishly? It's because in general, within the first 3 months of the Fed's first rate cut, the equity markets go into free fall over the past 25 years. So we have valuations at highs not seen since 2020. Before that, 2000. Check that box. We have a Federal Reserve that's out there afraid of something, but the data released today gives no indication of what that might be. Could it be unemployment? Yeah, I would buy into that. I would buy into that. Could it be the fact that this is a political move? I would also buy into that. But the problem is for equity buyers who are chasing this market right now is that A, they're paying attention to the lessons of the uninverted yield curve. B, bullish percent index. Forget about valuations. Think about sentiment. Think about the optimism that's out there right now. We are at highs at current. Let's go to a weekly chart. We are at highs last seen back in 2024. We got a beef drop down back then. But remember, we're going into a pause and we were looking at potential Fed rate cuts. What did they do? They bought the news. Before that, here in 2023, what happened then? Bear market. So we're in a range right now where, let's just take a crayon out here and draw some lines. Here's the upper band of the range. Here's the lower band of the range. Let's ignore the outliers and say, okay, we're a stone's throw away from being pretty frothy on sentiment. There's a lot of sentiment out there, a bullish sentiment. Put call ratio already went over. How this plays into the, let's see if they updated this yet. No. Usually what this implies is that you have less puts being purchased, means there's overly bullish sentiment in the market. That correlates perfectly with the bullish percent index. Bitcoin rallying with the rest of the market here. This is a weekly chart. This is breaking out higher in all probability. I don't want to spend too much time on it. CRB commodity index, we already went over. Let's get rid of those two. Yield curve, we already went over. Yields. So on Sunday, and then with members on Monday, and then on Tuesday, and on Wednesday, I went over the fact that I thought yields were going up higher, the longer term yields. And sure enough, it's exactly what happened. I just got an alert that fired off on the NASDAQ. NQ just broke support down just shy of a 1/4 percentage point. Let's check in with the E-minis. Down 0.13%. Not all that concerning. You got to expect some give back here. Okay, so the Federal Reserve just cut rates, but yields on the longer curve, the end of the curve, are moving up higher. The 10-year yield is moving up higher. So why might that be? Could it be that the bond market anticipated the Federal Reserve's actions? Yeah, I anticipated the Federal Reserve's actions. If an idiot like me could do it, certainly the bond market could do it. Could it be that what the bond market is saying is, you guys are out of your effing mind? We know what you're going to do. What you're going to do is that you're going to create a bear market, but it's going to be an inflationary bear market. The thugs in Washington are still going to print money hand over fist. And if the long-dated maturities, 10-year, 5-year, 30-year, 20-year, if they continue up higher, guess who's going to step in and buy those bonds if the rest of the globe is dumb enough to buy them? If they don't show up to our auctions, well, guess who the buyer of the last resort is? That's going to be the Federal Reserve. And that balance sheet I showed you earlier, which is going like this, after going like this, is going to go, it's just going to explode higher. If you thought the prior high on the Fed's balance sheet was high, you ain't seen nothing yet. They're going to, there's the law of diminishing returns. They are going to have to double the size of their balance sheet to get the same bang for their buck to keep the stock market moving up higher. And don't forget, the federal government of the United States of America now pays more on interest than it does on military defense, in excess of $1 trillion. We cannot afford it. They're going to have to play with the longer dated maturities so that our borrowing costs stay low. So that way Treasury can issue debt and not pay that much on the coupon. But the rest of the world is going to see this and say, you guys are just nuts, man. And they're not going to buy into it. And the Federal Reserve is going to have to be the buyer of last resort if they want to survive. Let's take a look at what yields did today. Daily chart, yield, 10-year, skyrocketed higher. No great shock. This is no shock. Go back and check Sunday Night Futures Live. We predicted this was going to happen. We predicted that we were going to get a correction in, at least a pause. I shouldn't say a correction in the TLT, a pause, a pullback on the TLT, which we've got. We're down a little over 1%, no big deal on the week, daily view. 3 consecutive down days, island reversal on the day. We closed back above 99. Perhaps we'll get a rally. Tips, frankly, kind of overbought on a weekly time frame. The fact that we sold off a bit this week, we're still up on the week. No great shock, because what happened yesterday? We had the dollar skyrocketed after initially falling. Yields fell, then moved up higher. So the tips are saying, what do you want from me? But it looks as though, let's go to a daily chart here. It looks as though they got one message yesterday and they realized what the Federal Reserve was up to. They're about to create inflation. Remember what this is. This is a proxy for inflation. Tips go up, inflation goes up, or vice versa, I should say. So they sold it off yesterday. Big bearish reversal bar, no follow through today. The dollar closed up yesterday, broke down today. Excuse me, this is a weekly chart. I'm sorry. We broke down this week. Let's go to a daily chart. Big move up higher yesterday. Big bullish key reversal. Inside bar today, no follow through. And I mentioned this last night on Market Wrap. Even though it's a beautiful candlestick, I don't believe it. I didn't believe it. I don't think it's going to hold up. And I still don't think it's going to hold up. The moving averages are telling you that. 50-day rapidly approaching the 200-day moving average. The euro is telling you that. Weekly chime frame, euro is breaking out. Think about this. The Federal Reserve is embarking on as Peter Schiff would say, it's the monetary Roach Motel. You could check in, but you can't check out. And this is just another iteration of the same thing that began back in 2000. Rinse, wash, repeat. So the dollar is rolling over. As expected, euro is rallying. Even the Brits didn't raise rates today. Japanese yen. That's down on the week, but that's been in fuego, taking a rest. Volatility. Down on the week, bearish reversal bar. One trading day left to go. We'll see what happens on the FedEx numbers and some retracement tomorrow. Now, this here is a pretty chart. Real pretty chart. Dow Transports. A beautiful breakout on the week. I've been looking at the same chart for so long. I'm dying to make some changes here. Right now, we have a breakout. Very pretty. Very pretty stuff. There's nothing wrong with this chart. At current, one trading day left to go. Let's see what tomorrow brings. And I would expect that we're going to get a retrace in the coming days. Dow Jones Industrial Average up 1.53% on the week. Honestly, not a big move. Felt like a bigger move today. Volume is okay. Let's go to daily view. Virtually all the gains came today. How was volume? Volume was good. S&P 500 weekly view, all-time record highs. But I'm sorry, this haunts me. This haunts me. I can't ignore it. People want to know, hey, what's a bearish divergence? You're looking at it. Here. That's a bearish divergence. Lower highs on RSI, yet we're at all-time record highs on price. What's wrong with that picture? Daily view. A big move today, up 1.71%, but kind of looks like a doji star formation to me, a sign of indecision. Volume is very good. Let's see how they close this out on the day. 30-minute view. You know, not horrible. You know, they pulled us back at the back half of the day. This is not horrible. Big selling into the close. And that's before the FedEx numbers, unless they had access to it, which is entirely possible. Trip Q's weekly view, potential breakout, no new all-time high, potential breakout on the week. Now, what's significant here is that we had a bearish divergence on RSI, as noted here. At current, we have broken out. The same cannot be said for the slow stochastics. Both of these are momentum oscillators. One trading day left to go. Volume on the week is no bueno, but today really matters. So let's go to the daily chart. Great breakout. Again, we had a bearish divergence. We have now broken out on RSI, but Stokes not confirming RSI. Not that it has to, but it's a nice to have. And we got stuck at resistance. Good volume. Good volume. It was a complete one-sided day. It felt like a very light volume day to me, but it's simply because there was just buyers out there. Very little selling today. Here's a 15-minute chart. Not a bad close. Small caps. Let's go to IWM. Up 3.29%. Setting up nicely here. Nice cup. We do some backing and filling, creating a handle. Small caps generally outperform large cap names 6 months out from the Fed's first rate cut. Technology. Good week, up nearly 1.5%. Let's go to the daily chart. Gapped higher, a little bit of fade on the day. How's volume? Volume was good. Let's go to the semiconductor space. This one really matters to me quite a bit. Semis up 1.76% on the week. Thin volume. What do they do today, though? Big gap up higher, 4.33% on the day. They recaptured the 50-day moving average and closed there for the first time since July the 22nd. Volume, very good. Let's go intraday to see how they close this out in the 30-minute time frame. I always focus on the close to give me a vibe for how they might open it up the next day, because that's when institutions generally position for the next day in the afternoons, that final hour, half hour of trade. And you can see there was some selling here. While this volume bar is very high, you have a big topping tail on top of this candlesticks, which implies you had some big red bars in there as well. And there you have it. Woo! That's not mom and pop selling 100 shares of SMH. That's institutional money seeking liquidity. Biotechs, no breakout on the week, nothing to do there. Discretionary names, excuse me, staples. Staples, wow, they really broke down. Not shocking. What's the reason why the staples are breaking down is that while you had everybody biting on their fingernails, worried about was the Fed going to cut, were they not going to cut, blah, 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 they were buying the staples as a safe haven. Now that the news is out, they feel it's safe to go back in the water. They're ignoring the yield curve and they're ignoring all the warning signs of the economy. And what they're doing is now they're selling staples, going back into high-risk assets. It's just the way it goes, sector rotation. Pete, someone said that recession begins 11 months after the last rate hike. Last rate hike was last July. Okay. I cannot refute that statement. I can't confirm it, but I will take you at your word, my friend. Good, sound advice. That's one for ChatGPT. Sage advice, as they'd say on Wall Street. Consumer discretionary names. They're moving up higher. 2.42%. What do they do on the day? Big gap up higher. I'm probably going to sell a call spread here as soon as tomorrow on XLY. Members, stay tuned for an alert. That's a short bet. But a short bet, high probability short bet. Emerging markets, getting ready for a breakout. Dollar rolling over. Equities still rallying. Looks like they're going to break out with the rest of the market. Energy up nearly 4%. For energy to rally and to stay in rally mode, let's go to a daily chart. You need to have oil. They are highly correlated. We already went over oil. We know that it broke out or moved up higher on the week. We have a breakout on energy. Wait for a pullback and a retracement. I would not be a buyer just yet. Oil on the week. We've already gone over this one. Up over 1 3/4%. What did it do on the day? Strong day. Very nice price action. It could be too soon time to buy the energy stocks. Gasoline prices. We spoke earlier about inflationary pressures on the market. Now, remember, the next CPI report that's going to come out, what CNBC is not going to do is put things into context, right? So we had the first rate cut, right? That's in the books. Now, everybody out there is going to say, oh, that's inflationary. That's inflationary. And it is. But you're going to get the next CPI report that comes out, and it's going to reflect prices for September. But look at the prices of gasoline for September. Yeah, they're coming off their lows now. But by and large, gasoline prices have dropped like a rock in September. What about oil? Can the same be said true of oil? You darn tootin'. Look at this sell-off here on oil. Yeah, we're bouncing back a bit, but net, energy prices are down on the month. So that core number, ex food and energy, that could come out hot. But when you look at the headline number, that could look really, really cool. Really, really cool. Enough for the pundits on CNBC to say, look, see, the Fed cut by a half basis point didn't create inflation, but wait till they get the read in November for October and then the read in December for November. That could be entirely different reports. That's your inflationary bear market that you could be looking at. So don't let them take parking space up in your head. You got to put things into context. This next CPI report, this next PCE report means nothing to us. The last one meant nothing. This one's going to mean nothing. The one released for November, that's going to matter. Because we're seeing inflation bounce back. Rising stock prices, guess what? Inflationary. Rising energy prices, inflationary. Gold. Still up on the week. Took a little bit of a dip yesterday, but Pimp Mac Daddy. Let's go daily view here. Franklin, welcome. Welcome, my friend. Gold daily chart, bullish, key reversal. Good stuff. This goes up. Mining stocks took some breather today, but look at last week. I mean, we own these, loving them. I'm not selling. Palladium, we still own. That took a little bit of a pullback, but look at the daily chart here and how overbought it got. Let's go to the daily view. It pulled back. Look at the bounce back here. Really good price action. Wow, that's strong stuff. We remain long of Palladium. Nugget, we own this as well. A little bit of topping action on the week. We're not letting it go. Silver, this is a leveraged product. Look at this retest. We broke out last week. Retest this week. Silver is a buy. A buy. Beautiful price action. This is the non-leveraged product. Up a 1/4 percentage point. Silver miners down on the week, but again, they have to digest this massive week they enjoyed last week. We own them as well. Now, Super Micro, there's something very, very wrong with this company. It caught no bid. I don't think they filed their 10K. They managed to eke out a gain. I think the stock breaks lower. I would avoid. Let's do some chart requests, and we're going to call it a night. God damn. It's almost 7 o'clock and almost dark out. That depresses me. Okay, folks, we're going to be using TrendSpider automated technical analysis. If you don't have it, it's like being an archer without the arrows in your quiver. Please, automated technical analysis, great scanning, great alerts. If you're new to trading and you don't know how to draw trend lines, well, this is for you. If you are experienced, then do as I do. Validate the accuracy of your trend lines. Because sometimes you find some really good surprises and very pleasant surprises at that. So 35% discount code below using the link on YouTube, above on Twitter, and that's the minimum discount. They probably even give you a better discount once you get to the website. So use the link to go over there, help support the channel. Yes, I catch a piece, and I know how long people stay members for. They don't leave. So if they're subscribing for years on end, that means it's a good product. And I've been using them since 2017. Let's go to, oh, by the way, folks, also below is the link to our new trading community. I haven't mentioned that. And that is where we have published our chart requests. I posted these because I got this out late. DGT, Oxy. There's a link below. If you want to join us, it's free for now. Great people. Sign up, no charge. All right, DJT. I think this is for talent. You know, of course I want to love the company. I can't. Can't touch it. You know, you're at support, to be fair here. On this weekly chart, in solid lines, you have weekly support and resistance. Click of a button, they're gone. Click of a button, they're back. Now I want to overlay monthly support and resistance on the weekly chart that appears in dotted line. As of right now, we have broken through monthly support. The month is not over. Maybe we bounce back. Maybe we bounce back off of these weekly support levels. I'm not feeling good about this company, to be honest with you. Daily chart, we broke support today. I'm sorry. I want to be a bullish guy. I want to be a bull on it. You know, I gotta say it like it is. That's the way I roll, and I gotta say avoid the stock. Oxy. Weekly view. Okay, so we've stopped going down. We landed right at our support level. Let's get rid of these two. I drew these. This one I drew. We landed right on it. And we bounced. So let's get our crayon out. At current, we have a breakout on a weekly chart. Sean, you're welcome, my friend. We have a breakout on a weekly chart. We've stopped going down. Good stuff. We know oil's going up. We know energy stocks are going up. Buffett owns it. I say buy. I think it's a buy right now. However, beware that yield curve because, folks, once everything starts to sell off, nothing's going to get spared except for bonds. Bonds, maybe the dollar. Gold will be a safe haven. None of these stocks are going to withstand the wrath of the selling that's to come. So be careful here. I would stay small, but I would be fine with nibbling on a position given the fact that we have stopped going down. Oil's going up. Energy stocks are going up. I think it's time to revisit these names. And I think that is it. All right, folks. Thanks for being here. Everybody have an awesome night. like, subscribe. You know the deal. And don't forget to join our free community. I have a link below. It's called Bulls and Bear Banter. There's a chat room. There's the feed. Everybody has a feed. And join us, and look forward to chatting with you. Make sure you say hello when you stop in, okay? Thank you. Have a great night. Be well.